Hi everyone, Arry here. Thanks for joining us for our AMA. This one is with Mark Anstead. We love him. He's so good at explaining things very simply and with enough technical detail. So this time he joins us to talk about all things DeFi, and that's DeFi stands for decentralized finance. I hope you learn as much as I did because I always learn every time we have Mark with us. These AMAs are every Friday from 2 to 3 p.m. now, PST, Pacific time. So feel free to join us. You can sign up under the Blockchain Underground on Meetup. Don't forget. And then also, I also teach a course with Steve. This is a 8-hour Bitcoin, blockchain, and crypto workshop. It's all the fundamentals rolled up into one short 8-hour course. You can spend months and weeks and years trying to figure this out, as I did, or you can take my course and get it much more quickly. We cover everything from blockchain, Bitcoin, Ethereum, IPFS, OPSEC, smart contracts, all of it in there. So if you want something easy and someone to just walk you through all the fundamentals, we're here to do that for you. Just sign up by clicking on this QR code. All right, hope to see you at the next AMA, and I hope you really enjoy this AMA with Mark. Thank you, bye. So let's kick it off again because not everyone always remembers who's who. With Mark, give a quick introduction of yourself and how you got into Numio and how you started it with your co-founders and your background in DeFi, and then we'll go from there.
Sure.
Thank you.
Yeah, well, thank you for having me. Thanks for the little intro, and I'm excited to answer some questions. Hopefully I can let you guys leave this little talk learning something new. So as Arry mentioned, my name is Mark Anstead. I'm one of the co-founders of Numio. Our goal is to basically allow you to buy, sell, trade, invest into crypto, and even NFTs. But our main focus is around Ethereum scaling. We were the first wallet to natively support zk rollups, first in zkSync, and building around a variety of zk rollup solutions. So I guess a little bit of my background in the space. I've been working full time in the industry for the last few years, started working back in 2017. I actually don't really have any corporate background experience. I started working in the space when I was in college, just kind of dove headfirst into the industry and absolutely loved it. And here I am. So some would say I'm a little bit of a quote unquote crypto degen. Whether that's a good thing or a bad thing, I like to experiment with a lot of new technologies, trying to stay at the forefront of everything that's going on, and have been basically interacting with different types of on-chain protocols, especially around the DeFi space, pretty much back since Ether Delta and Fork Delta. That was way back in the day. That was before the Uniswap days.
Yeah.
And so I've always been very excited about the whole concept of completely staying non-custodial, having full sovereignty over your funds and everything that you're doing online. It's really empowering, and it's exciting. And obviously, as some of these new innovations have popped up in the whole DeFi world, there are ways that you can essentially put your money to work and start to generate yield on your money, or obviously you can trade and do all sorts of different types of things. And so I love to just kind of plug and play with some of my money and basically figuring out how things work in that manner. So I guess that's a little bit of my background in the industry. When I started Numio, that was back in 2020. I've been building around Ethereum scaling for quite some time. Saw a presentation at the last DevCon, which was back in 2019, from the now Optimism team presenting Unipig. It was like the first public unveilment of rollups, and basically fell into the rabbit hole of rollups, started learning about zk rollups, and basically set out on this journey to build out the wallet infrastructure for layer 2, and specifically focusing around zk tech. So I guess that's I guess the full background about a little bit about myself and Numio, and I guess some of the stuff that I've been doing around DeFi. So again, thank you all for having me, and I'm excited to answer any questions.
Yeah, I thank you for being with us, Mark, because every time you've been on, you explain things so well. And I love the fact that you're in the trenches and you know so much about what's going on. So I think that's going to be very helpful for us. Can I just kick off with like, you said something about DeFi and earning yields and stuff like that. And that for me triggered the whole like BlockFi, Celsius, Voyager stuff that's been happening with, the 3AC folks and stuff. Why do you, can you talk to us on like, what are your thoughts or reactions to that whole debacle and what's been going on? And then how do people still continue to, reap the rewards of yield without losing their confidence in the system, especially after the 3AC stuff?
Sure. So just to give you guys a little bit of background, if you aren't familiar with what happened with 3AC, Voyager, and BlockFi, there was a massive contagion that occurred about a month or two ago. Contagion is an understatement, where multiple firms have now essentially filed for bankruptcy, and it's caused a massive problem for the entire industry as a whole. And 3AC got liquidated, and basically they got margin called. So it created a lot of ripples in the entire industry. So let's understand kind of what went wrong there. So what happened is 3AC, they're a quant trading firm. So they are going and trading, whether it's on spot or on leverage, on different types of either centralized or decentralized exchanges. And there's different types of institutions, whether it be BlockFi, Voyager, Galaxy Digital, Celsius. They will go and take their users' funds or their own funds and lend them out to institutions. So with the situation that happened with 3AC, in many cases, most of those loans were completely uncollateralized loans. So 3AC didn't really need to post collateral for the most part for some of those loans, which means that if they don't basically give those funds or institutions capital, then they don't really need to. Like, they can just go and receive their money, do with it as they please, and return funds back with interest. Generally, it's with a short-term interest, so it's fairly high. And that interest, let's say with Celsius, BlockFi, or Voyager, they would give a share of that interest to their users. So the very important clarification here is what happened with a lot of those firms has actually nothing to do with DeFi. It's completely separate from DeFi. So with DeFi, everything is essentially on chain. You're not dealing with any type of custodian whatsoever. And I mean, there's different types of risks involved with DeFi, because it's not to say like it's perfect, but it's definitely safer in that regard. So I guess that's a little bit of the background that happened there. And the really interesting thing is, with this entire contagion that happened over the last couple of months, pretty much everything that actually happened within DeFi acted exactly as it was supposed to. Nothing actually went wrong. Everything was completely perfect. Some people did get liquidated, but all those liquidations happened completely on chain. And everything from the protocol layer was acting exactly how it was supposed to, which is awesome to see. That means that these protocols are being battle tested, and that they are able to provide a little bit more trust, especially from the public eye and even from like the user perspective. So that's, I guess, a little bit of background around what happened there. And with regards to, I guess, yield in that regard, there are different ways that you can generate yield within DeFi. So you can deposit funds into lending markets, into yield aggregators. You can basically pool your capital together into different types of automated market makers, which basically trade your funds. And yeah, I guess different things like that. I'll sort of take a pause there before I could go on a little bit of a ramble, and I guess stop and see if there are any questions before I go any further down the different types of rabbit holes.
Yeah, I think that's a good summary, like a really good summary. I think folks are realizing that, maybe this decentralized DeFi thing is actually better, especially with the whole, what did you say, massive contagion, uncollateralized debacle that just unfolded before our eyes. And I feel like there's still going to be more that's going to come out from the shadows that, as more time passes. And so we'll just, only time will tell how bad and how big this really is.
Yeah, I think that is definitely an understatement. I think we were starting to see some of it, especially when 3AC did basically like file for bankruptcy, basically ghosted everybody. Mainly because, so one of the things that many people don't know about is, so obviously 3AC, they're a massive hedge fund, they're quant traders, but they are also very reputable investors in the industry. And so one of the things that they were actually doing for a lot of the firms that they were investing into, they were actually, I guess, offering yield for any of the funds that they basically helped them manage. They basically said, if you store your treasury with us, we will offer you 10% yield every year. So basically you just give us your money and we'll offer you 10% yield. So basically what they were doing with those funds is they were obviously going and trading with them and doing all sorts of things. We don't know. And that's the thing about how, when you're dealing with a custodian, there are obviously risks associated with that you might not necessarily know what's going on behind the scenes. So there were a lot of crypto projects that ended up getting hit by this entire mess, just because they even had funds in, I guess, that were custodied by 3AC that obviously they're probably not going to be getting back. So it's definitely had quite a bit of rippling effects. And it's been a interesting last couple months. It's definitely caused a lot of people to learn some lessons, but yeah.
So that's why business case for decentralization, yay, and non-custodial wallets. On the point of non-custodial wallets, though, have you been tracking what's happening in Europe? Because there's some legislation proposed, not quite legislatively in process yet, about requiring all non-custodial wallets, all like self-custody stuff, to be basically blocked and blacklisted from interacting with any of these exchanges and crypto services. And it's kind of, if it actually does happen, it's going to set some like pretty scary precedent across the world on how do you even do that, because I think it's really difficult to just block on non-custodial wallets in general as a company and be able to figure out what's non-custodial versus custodial. Do you have any thoughts on that, and how is it going to affect DeFi?
I mean, I don't think it's necessarily going to, I guess, affect it in the grand scheme of things, because there's no way that you can necessarily prevent people from using DeFi or even using a self-custodied wallet. Just because, I mean, you could go and run your own full node, or you could just go and run your own node and create your own wallet in that manner and go and interact with things on chain. You don't have to actually use third-party providers. Like companies like Numio, as many people, as I mentioned earlier, we are a non-custodial wallet. So you have self-custody. And as long as you are connecting, like if you have a device and you're connecting to some type of node, then you can go and interact on chain however you please, and there's no one that can actually prevent you from doing so. we would just be like an interface making it easier for you to do that. But there's nothing preventing you from being able to go and do that on your own, even without Numio. So would it make it harder for people to do that? Yeah, it would make it a little bit harder, but there's frankly no way to actually prevent that, especially at this point in time, since we're, I guess, this far into the industry and it's grown this much. It's literally impossible to truly regulate it in that manner. Because I know there are some people who are basically saying, okay, you need to go and KYC everybody that is depositing and withdrawing from exchanges. So what happens, like obviously if you're using a centralized exchange or some type of custodial product, someone deposits money into your account, which anybody could frankly go and do that. And you have no way of basically saying, oh, I can't really KYC this address. It's literally a public address. I have no way of doing that. It's frankly impossible. Obviously, would that be smart for people to go and do that? Probably not, just because they're obviously losing money. But I wouldn't be surprised if that happened, that there would be a lot of, I guess, some of the crypto punks out there going and doing it just out of spite, just to annoy people and create a point, I guess. But it's a very double-edged sword with what they're trying to do there. I don't think regulation is necessarily a bad thing, especially with what we've seen over the last few months. But it's a very slippery slope going down that path. And honestly, I don't really know what's going to happen. I don't know anybody could say what would happen, just because it's right now it's a lot of speculation. I mean, we've seen a lot of countries attempting to ban crypto as a whole. China's done it a bunch. I mean, they've done it probably like 10, 15 times at this point, even though China is one of the largest user bases of crypto. India's done it, and it doesn't really do anything for the most part. So I don't really think it's going to have that much of an impact. I think people are still going to use it because there's no way to really prevent it from happening for the most part.
Kind of works like with a kid in a candy store. Don't eat the candy. Right. Looks like there's a question in the chat from Steve. How do some of the layer twos like Numio, Starknet, zkSync differentiate from one another? Competitive advantages?
Sure. So Numio, we're a wallet. So we actually work very closely with those teams like zkSync, like Starkware. Starkware is the team building Starknet. So our goal is to be very agnostic in that perspective. We want to help support them. We want to build the ability for you as an end user to interact with those ecosystems. So from our perspective, we're not trying to like pick and choose and say one's better than the other. We want to basically help support all of those ecosystems, especially in like the zk tech space, to help support them and allow them to grow and to scale, and for their users to have an interface to interact with. In terms of competitive advantages for these different types of ecosystems, some of them differ in various ways. So there's, I would say, 4 or 5 main roll-up solutions at the moment. So there's Starknet, there's zkSync, there's Polygon Hermes, there's Scroll, and there's Loopring. So let's sort of break down each one of these. So Starknet is probably the furthest from how Ethereum operates. So some of them are building like EVM compatibility. If you're not familiar with what EVM compatibility means, it means that you can go and interact with it in a similar manner as you can on Ethereum. With Starknet, it's literally like the complete opposite of Ethereum. It is very roll-up specific with how it's built. So it's built so you can build application specific types of products on top of StarkNet. Their programming language is very, very different from Solidity. It's very different from Rust. It is a custom language that was created by the Starkware team. It's called Cairo. The really cool thing about Cairo is you're able to have on-chain imaging, and the processing capabilities are incredibly powerful. But obviously the major downside is it's much harder to use that programming language. Very few people know it. I would say probably only maybe 5,000 to 10,000 people around the world are using Cairo at like the max. I'm saying that just because that's how many like downloads there are on their library. And then there's zkSync, which is building in a similar manner to StarkNet, where they're not necessarily EVM compatible, but they are building a solution that allows you to port over different types of Solidity smart contracts. So let's say like Aave, Uniswap, SushiSwap, Compound, basically the list goes on. Pretty much any type of thing that you interact with on Ethereum, you'd be able to go and take that and drop it into this little black box and spits it out to work on zkSync with their own virtual machine. And then there's solutions like Polygon Hermes, which are focusing more in terms of EVM compatibility. Scroll is focusing more in terms of what's known as EVM equivalence, which means they're literally trying to copy everything that happens on Ethereum. So how you interact with Ethereum, they're trying to completely copy that and make it equal, meaning EVM equivalence. So they're actually using Geth, which is Go Ethereum, which is a client to basically run the Ethereum virtual machine. So that's extremely close to how you use Ethereum. And then with Loopring, there hasn't been too much information about their ZK EVM yet. So I'm just kind of keeping an eye on that. They've said that they're going to be launching a ZK EVM, but haven't really seen too much information there.
Interesting. Cool.
So, does that answer your question, Steve?
Steve nods, thumbs up.
Perfect.
Cool.
I'll take it.
I guess do other folks have questions? And feel free to put it into chat or raise your hand using the reactions button at the bottom of your Zoom window. And while we do that, I guess, Mark, what do people get wrong about DeFi that you see most often as you interact with people in different communities?
Oh, here's a good one. So one of the things that I would say misconceptions about DeFi is that everyone thinks that when you're interacting with DeFi, that it removes the middleman. So like everyone says like when you're interacting with like a custodian, let's say a bank, the bank is the middleman. And then when people are interacting with DeFi, they're like, oh, there's no bank anymore, so there's no middleman. But that's actually not necessarily true. There is a middleman, because obviously a bank is generating profits in some form or another, whether it's through interest or having deposits, whatever it may be. So they're a middleman. They are generating revenue from your money. And with DeFi, obviously it's not the same concept because you're not using a custodian, but there still are middlemen when you are dealing with DeFi. Those middlemen are actually the smart contracts. So these smart contracts are the ones that are the middlemen, because these smart contracts, whether they're doing one thing or another, they're probably going to be earning fees in some form or another. So the actual smart contract itself is the middleman, because it's in some form or another taking a portion of your funds. So let's say, for example, like with Uniswap. So when you go and swap on Uniswap or even SushiSwap or a variety of other dexes, there is a a fee that you basically pay for every single trade. So when you go, let's say I'm going to trade ETH into USDC or DAI into USDT, whatever it may be, they take a certain amount of bips on every single trade. Previously with Uniswap V1 and V2, it was 30 bips. Now with V3, there's a lot more customization with how much fees are taken based off of every trade. So for Uniswap V3, they have a variety of fee markets. There's 1%, which is 100 bips. They have 30 bips, which is 0.3%. And I believe most recently, they actually added in 1 bip, which is 0.01%. I believe that's what it was. I think there was a proposal about that because they've been trying to compete with another decentralized exchange, or as Arry mentioned in the chat, which is called DEX. There's another decentralized exchange called Curve. Curve is it's what's known as a stable coin exchange. So it's very different from Uniswap, SushiSwap, Dodo, or all these different types of decentralized exchanges. There's tons of them out there. Curve is very focused on one type of assets that are trading theoretically at the same value. So the spread for every single trade, or the slippage that you get on every single trade, is incredibly small. And the amount of bips that are taken, so when I'm saying BIP, I'm talking about like the percentage of every single trade. So like if I'm saying 100 bips, that means 1% of the entire trade. Meaning if I trade $100, then if there's 100 bips off of that trade, that means that $1 is taken in fees. So with Curve, they take 10 bips, which is 0.1% in fees. And so when you're going and exchanging stable coins, as an example, you're able to go and trade them through Curve at a much better price execution than you can on different types of decentralized exchanges, because the slippage is so much smaller and they're not taking as much in terms of fees. So that works with different types of stable coins, or even assets that are of technically the same value. So like, let's say for ETH, there's RETH, which is a type of interest-bearing version of ETH. There's staked ETH. You can even trade with like wrapped BTC and Ren BTC, which are different forms of Bitcoin operating on Ethereum. You can go and swap between those assets and do it in a much more seamless manner than you could through other decentralized exchanges. So does that answer that question?
I think so. Yes, definitely. Just for I guess definitions here, because not everyone is very crypto financially savvy. When you talk about slippage and bips, you explained the bips. Thank you for that. 100 bips equals 1%. And so it's 30 bips, it's less than 1%.
Correct.
When you talk about slippage, how do you describe slippage?
Sure. So I'm trying to think of like a good analogy for this. So obviously the word slippage means like you're like basically sliding. It's like, oh, I'm sliding down the street. Let's say you jumped on a banana peel and you're sliding a little bit. And when you are dealing with slippage, that means how much, basically how much price impact that it's going to have on that trade. So, so let's say there's a trade that has very, very high slippage. So I guess a quick quiz for you. If you have a trade that has really high slippage, and let's say you're sliding on a banana peel, do you want to slide really, really far and potentially hurt yourself? Probably not. So when you're going and dealing with trades, you want to deal with much lower slippage or price impact, because that means that you're able to essentially receive more of your money back.
Right.
Because if you have very high slippage, that means that you're willing to give up a lot more of your money to execute that trade. So higher slippage means you can have a higher amount of price impact. Lower slippage means that the price impact is most likely going to be much, much less.
The only time I've actually used the word slippage is like in these OTC type of transactions. And this is when I was working in a crypto company and I did like millions of dollars of transactions. And so then, you know, you talk to your OTC guy and be like, hey, I want to get Bitcoin at $1,000. I'm just making up numbers.
Mm-hmm.
And he's like, well, no, the price is, the current price is like 9,900. I'm like, no, I want, that's not right. The current price is 1,100. I'm like, no, I want it for 1,000. He says, no, I'm going to give it to you for 1,050 then, you know? So he has a slippage amount of 50 and I have slippage the other way of paying more than I want, $50. Is that a good way to talk about it or no?
Potentially, I would say that's more so caused by price impact. I would say slippage is how much you're willing to risk for that trade to go through. So like, let's say you have really, really high slippage. I'm going to explain a situation here, which can be very technical, and I hope it hasn't happened to anyone here, but it's a very real scenario in like the decentralized world. So if you're trading with very high slippage, let's say I set my slippage to 20%. That means that I'm willing to basically pay 20% more premium on whatever this asset is, and for the trade to go through. So what different types of bots will do is they will go and read different types of trades that are occurring to see what your slippage is on a specific trade. So if you have a really, really high slippage set for your trade, they'll do something which is called a sandwich attack. Sandwich attack is not good. You do not want to be sandwich attacked. So what these bots will do is they'll see, oh, this person's willing to pay 20% more for this asset than what it potentially is currently valued at. So what I'm going to do as a bot is go and buy up this asset, make sure that my trade gets executed before theirs. So the price is, let's say, 15 to 20% higher than what it was. And then you buy at a much higher premium. So then the bot will then dump it and you get sandwich attacked. So you immediately lose money on that trade, and the bot basically profits from arbitrage trading, or what's known as a sandwich attack.
That sounds horrifying.
Yeah, it's it's a pretty wild world when you're starting to deal with I guess a lot of on-chain activity. It can be there's an article, and I highly recommend checking it out. It's really interesting. It's called the Dark Forest. I'll actually see if I can pull it up and I'll send it into the chat.
The Dark Forest.
What's his name?
Sounds ominous.
He's on Samsung. Escaping the Dark Forest. This was one of the coolest articles that I've seen, and it gives you a very good understanding of what can happen when you're dealing with anything on chain. And it's very, very fascinating. So very cool stuff, and I definitely recommend it. It reads kind of like a novel. It's very cool. So it's not just like super boring, like technical analysis and technical documentation. It kind of reads like a storybook. So definitely recommend checking that out.
Thank you for that. I will share that out with the community too after this AMA. Brigitte asked a question. She said, how do we know the location of users? You mentioned that China is the biggest user base, even though that crypto has been banned multiple times. How do we know?
You don't.
And what degree do we know? Like, do we know state, location? What do we know about users?
So there's really no way to actually know, like technically for a non-custodial wallet, there's no way to actually know where a user is coming from because people can just use a VPN. And when you're dealing with a public address, let's say like on Ethereum, Bitcoin, or any public blockchain, or even a private blockchain, there's no way to know where that user is from. There's different types of on-chain analytics that you can use to figure out a general time zone that someone lives in just because of their on-chain activity. So if you have an address that has hundreds and hundreds and hundreds
So
of
you're doing
transactions,
time zone analysis to figure out that we have a lot of Chinese users, is that right?
not me personally.
No,
I
no,
just
but I mean,
that from,
Yeah, I'm just
I
wondering how to back that up, because it was in contrast with my idea or understanding that we don't know where people are. So,
this is yes. So we don't for sure know where a lot of these users are. The Chinese market for crypto, specifically DeFi, is quite large. I know that just because there are a lot of users that are interacting with these solutions, and there's massive Telegram groups that are incredibly active that are all speaking in Chinese. And I mean, there's tons of investors that are based out of China. So unfortunately, there's not like specific data saying this is how many people there are from China. I have no way to basically go and say I can back that up. There's no way of frankly knowing how many there are in the US. It's just not necessarily technically possible because like for me personally, I have like probably 30 or 40 Ethereum addresses that I've interacted with. And there's no way for people to know that's 30 people or that's just one person. It's almost impossible. So it's completely pseudo-anonymous. There's no way to really know how many people there really are. For a custodial wallet, it's easy because you have to do KYC AML on every single one of your users. But when you're dealing with a public blockchain and everything is completely, frankly, pseudo-anonymous and permissionless, there's no way of really tracking that information and knowing completely what's going on there.
Good. Well, I appreciate that. That's a very reassuring answer. For a moment there, I thought, wait a minute, we don't know where people are using things from. Right. Good.
I don't even know if I spelled that right, but I tried to write pseudo-anonymous, not anonymous, because a lot of people are like, crypto's all anonymous and there's the evil people doing nefarious activities. You're like, well, no, it's not anonymous.
Not really.
It's pseudo-anonymous. Yeah. More question. Harish was clarifying slippage equals commission paid to execute the trade.
No. So the commission paid to execute the trade is a fee. So that's known as like a trading fee. So sometimes if you like go and look at like the advanced section when you're going and trading on a DEX, for example, like even on like a website, it's better, you'll get better information on a website rather than like on most mobile apps. There's just not as much room to explain all that. But you can go and basically see how much you're paying in terms of a fee to execute a trade. I think I already explained a little bit about what slippage is. I can go and clarify that further if you need me to. So just send a message in the chat if you need me to explain that a little bit more.
Nope, I think that I just asked this while we were discussing about this. So yeah, that's fine. Thank you.
And same with mine. You already answered mine by your bot and sandwich example. So it is possible to have slippage grow prior to settling the transaction, right?
It's an arbitrage trader.
Oh, I mean, they're helpful. So the interesting thing about arbitrage traders and I guess these bots, so there's a term that these bots deal around, which is called MEV, which is letter M, letter E, letter V. SBF is a very famous arbitrage trader. He's a quant trader. He runs FTX, which is one of the largest exchanges, but he also runs one of the largest quant trading firms, which is called Alameda Research. They are literally a team of just degenerate crypto traders. They are the best of the best in the world. And so the interesting thing about these traders is they're both good and bad. So the ones who are basically doing different types of sandwich attacks and things like that, I put those as like some of the bad apples. Arbitrage traders, however, are not necessarily bad apples for the most part. They're actually able to create a little bit of a healthy environment in different types of permissionless ecosystems. Because what an arbitrage trader is literally just doing is creating price balances. So in different types of decentralized exchanges, they all have their own price feeds. So with Uniswap, you can go and find out what the price of ETH is based off of USDC. And then let's take the price of ETH, how much it's being traded at against USDC on SushiSwap, or on, I literally just name any decentralized exchange that supports two different types of assets. That creates a price feed. And that could be considered like an oracle. So an oracle is basically like, okay, this is literally the price of an asset. Like a project like Chainlink is basically aggregating these price feeds to give you an aggregated version of that price. And what bot traders or arbitrage traders can do is go and look at these differences in these price points and say, oh, okay, the price on Uniswap is at $1,800, and on SushiSwap, it's $1,500. So there's a big imbalance there. And so what these bot traders can do is they can read that on chain. They don't actually have to do it themselves. They can if they want to, but they have bots that will basically view and analyze this type of data that'll say, oh, I can go and sell a bunch of ETH on this market to drop the price, and then I can buy it on this market and raise the price. And so now they're at balance. And the thing is as they sell at a higher price and buy at a lower price, that's a profit for them. So it's kind of in that regard, that's a win-win situation, because the arbitrage trader is able to earn a profit, and they're also able to bring the market back to equilibrium, which is incredibly important because we need those types of individuals to basically go and say, okay, we need the price to be equal on these markets because it makes it better for you as an end user and as a trader. So like, obviously, if you want to go and create a bot yourself and do that type of arbitrage trading, you can do so. There's nothing stopping you. It's completely permissionless. Obviously, you are competing with all of the other arbitrage traders around the world, which can be quite competitive. There's a reason why I don't do it myself. So that's one of the interesting things about how some of these work. So they can be used in a good manner, but they can also be used to attack people in different types of ways. Like the example that I made is a sandwich attack.
Sandwich attack. I'm going to add this to our big glossary that's growing. Sandwich attack, slippage. Yeah. We had this thing called the kimchi premium back in the day. I don't know if it's reoccurred since then, but in Korea you could sell your assets for a bit higher, and so we would have some like US folks combine their resources and buy up Bitcoin at a certain price, and then send it over to friends or family members in Korea, and then sell it at a higher price, and then share the spread in the earnings that they made. And so that was a thing back in the day. I don't know if it still happens, but I'm sure it still does.
Wow, that's crazy. I wouldn't be surprised if that does happen. I know back in 2017, I mean, I made I should point out, I'm a terrible trader, awful, absolutely terrible trader. But I love to like play around with stuff. And back in 2017, there was one of the craziest arbitrage opportunities that I've seen. And it was one of the few times that I actually traded Dogecoin. I was doing it between, I think it was Binance and Cryptopia. I think that was the name of the exchange.
Oh, wow.
Literally don't recommend using it, but I don't even know if they're still in business, but the premium for it was like 20% on on one of the exchanges, and I was literally just going and arbitrage trading literally for like an hour or two, and made like a few $1,000s. Like, I mean, I was a college kid, and I was like, oh, this is amazing. And obviously that's on a much smaller scale compared to what a lot of these people do, but and that's just like I guess a good example of how it can be used in a pretty cool manner. Yeah.
So mental note, keep your eyes and ears open at all times and notice the opportunities. Hey, more questions on DeFi? Wallets, DeFi wallets? Tamara, you had wallet questions last time? Numio is a great wallet if you want to check it out.
Yeah, I have been checking it out. This isn't specifically related. I love what you said, by the way, about it being a misconception that there is no middleman. And I love the way that you describe the smart contracts as the middleman. And essentially, with a lot of companies out there, the smart contract represents a business that is itself a middleman, taking small percentages of whatever the transactions are. So things are sort of more decentralized rather than completely decentralized, which we talked a little bit about. I've been looking at wallets a lot lately and trying to think about what they're going to look like in 3 or 4 years. And right now, you're sort of right in the mental model of wallet equals cryptocurrencies plus wallet equals managing NFTs. And I think in a few years, elements of personal identity, not just digital identity, but pieces of digital identity that are like everything from driver's license to like small piece of your medical records are going to be sort of assets that you manage in wallets too. How are you guys thinking about or are you thinking about whether Numio is going to be in that spot as well, or?
Sure. So with regards to wallets, like as you mentioned, they're basically going to be the core piece of infrastructure that you do and interact with anything in a digital manner, because they are what you manage anything on a public chain, whether different types of your personal identity get stored in some form of encrypted data on chain. We don't know yet. Will it happen? Maybe. But those types of things are all going to be essentially interconnected within wallet infrastructure. So obviously right now you have crypto assets. You have digital assets like NFTs. We're starting to see a lot of interactions with the social side of things. We're basically at the very, very beginning stages of how I would call it social-fi is beginning to grow. And the core function and interaction that you have with all of these things all stems back to wallets. So like with social-fi, for an example, like we're really good friends with the Aave team. We're actually building in support for their lending protocol, but they just recently supported or launched a solution which is called Lens. Lens is a social graph that anybody can go and build on top of. So you can build different types of social platforms on top of their protocol. Hold on, so I'm gonna ignore that. So you can go and build all different types of things on top of their protocol around the social side. And how you interact with those things and how you manage what has been done there is all frankly done through a wallet, whether it's a non-custodial wallet or a custodied wallet. It's going to be a wallet of some manner, because those interactions have to be connected to some type of on-chain address. And that on-chain address is a wallet. It's an address. And so in the future, I would say later down the line from that, we're probably going to start to see different types of people sort of experimenting with how you're able to connect literally your like passport, driver's license, and things like that to your like digital wallet. I think we're a few years away from that just because of like regulatory side of things. So we'll see how that evolves. There's a lot of people that have tried to solve that problem, but it's never really, nothing's really ever come from it. I will say, like, I've attempted to do that in some of my previous work. Back in like 2018, 2019, I was doing some work around digital identity management. And I realized it was a lot earlier than we needed to be doing that. And so, yeah, I think it's, I guess, TLDR, wallets are basically going to be the core infrastructure to manage and interact with all of those things. And right now we're really just seeing it around your crypto assets and like your NFT assets at the moment.
So at Numio, you're just sort of waiting on that?
So for Numio,
which is legit, totally legit. I'm just curious.
Sure. So like right now with Numio, like we support crypto assets, we support NFTs, and we allow you, like through Wallet Connect and different types of middleware, to go and interact with different types of social graphs if you want to. You literally just have to connect your wallet, and you can go and interact with those types of things. We don't have native support for that right now. That's not like on a roadmap in the near future. Will that change in probably the next year or two? Maybe. We'll sort of see how it evolves. But we're just very, very early on with that market. So we're just kind of evaluating it and seeing how that develops before we say, okay, we're going to build in native support for this. So we want to see how it grows before doing that ourselves.
Cool.
Am I allowed one non-PC question?
Is it related to DeFi or wallets?
It was related to the sentence he just mentioned.
Sure, go for it. I mean,
so I'm curious, when you said you were too early for the digital identity, were you too early or was it too hard?
I would say it was probably a little bit of both. I think the adoption for it and how much people actually cared about it was pretty minimal. A lot of the other infrastructure around it was not great, and you weren't really able to gain that much traction. So it really didn't work. And we've seen that for a lot of teams that have been building around digital identity management, that are trying to connect like off-chain information to on-chain addresses or wallets or things of that manner. Teams who've been focusing on specifically on-chain identity aspects have done quite well. I would say like ENS, Unstoppable Domains, like POAP. I would consider all of those to be like on-chain identity solutions, and they've done very well. But connecting off-chain information hasn't really evolved for the most part.
What's your favorite on-chain identity solution?
My favorite is probably ENS. I've been using ENS for a few years. I'm a huge fan. I like what they're doing. So yeah.
Oh, I have a friend that's kicking off a new startup. We should have them on soon. I don't know if he's completely launched yet, but he's doing ENS for phone numbers. Enum is what he calls it. So you should check that out.
Can you post a link so we can check it out?
I actually don't know what the link is. I think his link is like really weird. It's like enum plus some like derogatory word or something. I'll look it up.
Could you send it to me on Telegram when you find out?
Yeah. Let me look him up. Chris.
Thanks.
Oops.
And one more question, if I may, while she's doing it, Mark. So do you feel there is enough tools on a blockchain to create a solid digital identity on a chain? I haven't used DNS. Does DNS able to tell you that those two wallets belong to the same person or not?
So you don't really know who an ENS belongs to.
No, I know that, but I'm just, all I'm trying to solve is to be able to decide that those two wallets belong to the same or different people.
Potentially. I mean, it depends on how that person connects those wallet addresses. Like if
they don't connect, if the addresses are not connected at all,
then there's no way of knowing that they're connected.
Okay, so that's what I'm trying to do.
Got it. Okay.
Cool. I just wrote down the URL. It's enum.wtf. enum.wtf.
I love it. I think I would love this.
I love the .wtf. Big
I saw that, I was like, what?
fan.
But I think I heard this one. I was like, I would actually drop all things and go work for this one because I think it's a really good it's like taking your identity and your phone number and tying it together. And he wants to use this as the beginnings of that identity to your the Web3 on-chain world. He had another identity startup previously that didn't go all the way. So he's learned a lot in the meantime. We are out of time though. So I want to say thank you very much to Mark for joining us and giving us some insights about the world of wallets and DeFi, and giving us some really good definitions to narrow down and add to the bigger glossary. Thank you to everyone, the community, for joining us and asking some good questions. If people want to get back in touch with you, Mark, he is in our Slack, so just ping him in our Slack. But otherwise, what else, Mark?
Mark, are we connected on Telegram, or can you post your Telegram, or can I post mine?
Sure, I can. What I'll do is, instead of trying to explain it, I will type them in the chat. So there's my Twitter. I'll post my Telegram. Probably would be easier if
You're not posting to all of us. I think you're just posting to Arry, but that's okay.
In the Slack.
It's going to everyone. And then yeah. So for Numio, Twitter.
What are you doing in the Slack? Oh, there he is. Slack.
Numio, and
Oh, the Slack group link here. I'll put the Slack group link in.
and I'll
Everyone's
also post that in the I'll post that in Slack as well.
Copy link. Here we go. Slack link. Feel free to join.
7 milligram.
And then
Mark, I posted my Telegram for you so you don't freak out, because I just learned that everybody's freaking out when I just send them messages.
It's a question mark.
I am.
But yeah, Mark is Numio. Twitter is @GetNumio, GETNUMIO. And then Mark is on Twitter @the_shark_7. And Telegram, he's @Anstead, ANSTEAD, followed with the letter M, Anstead M.
The one and the only.
Mark, do you see my name on my Telegram on your chat?
I'm sorry, could you say that again?
Can you see my Telegram on your chat?
IQ Dan.
Yep, you got it. Thanks. It's a question mark, just so you know. Don't freak out.
All right. Well, thank you everybody so much for joining us. Happy Friday. Oh, and then I'm actually changing the time slot for these AMAs going forward. I'm sorry if it screws up some people's schedules, but it's causing some heartache for me. So we're moving it to 2 p.m. Pacific going forward. East Coast, that's 5 p.m. So 2 to 3 p.m. going forward, no longer the noon slot. So FYI, make sure you note the time change, and happy Friday, and we'll see you next week, hopefully.
All right. Welcome to Windshield Time, y'all. Thanks for tuning in. This podcast is non-technical, fun, informative way to learn about money, Bitcoin, blockchains, crypto, and digital assets for busy parents and working folks who are curious about these new technologies. Day, Arry, and their guests talk about these evolutionary systems of money and what they do, y'all. Because what part of your life does money not touch? This podcast is not financial advice, and your reactions are your total and complete responsibility, y'all. Now, thanks again and enjoy the show.
Stuck inside.